So how's life?
Good. Good.
Yeah. Ugh. What's going on?
Rocking and rolling.
I'm gonna get you to slide down a little bit.
Me
more.
slide down here.
Yep.
What's the latest? What are you up to?
Working on some new stuff coming out.
Are you all work, no play, or?
Oh no, I got plenty of play. Don't
He's
you
all
worry.
play, no work. So we saw the royal OpenAI just dropped something big an hour ago. John, show the screen. So the killer use case, the app for crypto is here. Oh no, not crypto. For AI, it's here.
What do you mean the killer use
killer
case?
app. Check it out.
What is it? Operator? Oh, this is the agent. Yeah.
Oh, the agent.
Yeah. So they just.
Agentic AI.
So look, what can I do? Book a table.
So it'll talk to OpenTable for you.
Yeah. John, go to the next one when you get a chance. So they show getting dinner reservations. This is pretty cool. So if you write out a grocery note
Yep.
and upload it, it will read the
Who is the
grocery
grocery
note.
Will it
partner? Is it
just
gonna
go
be
right into
Instacart?
Fresh Direct and just deliver it for you? Write it
I
out.
bet you it's gonna be
Fresh Direct?
Instacart. It's Instacart.
It's going to be
Oh,
Instacart.
Instacart.
Yeah.
Well, the good thing is,
So
then it goes to a person, and you only get about 50% of the shit that you order.
No.
right?
Oh, yeah.
No,
I
so-
mean,
but anyway, so it's not just, it's going to be every Instacart competitor. And then
Of
also,
course. And it will be a robot doing the Instacart in 2 years.
yeah. And
So-
StubHub, they do one with StubHub, but you can get tickets. So all of the shit, it's here.
what I want on this is, if I'm like planning a vacation or whatever, just know my preferences, find the flight,
It's coming.
find the hotel, just deal with all of it.
So a lot of people say that would be the last thing they would want because of how specific people are with travel. And a more obvious thing would be get me 2 tickets to see like the new Star Wars movie.
So that's in there.
Yeah, no, I'm
Yeah.
saying like I feel like
But, no,
travel
Like
is
But it
that's
depends,
easy.
but
Like
you're
I can
very-
do them. How much does that save?
you could
30
do that
seconds.
yourself too.
30
You're
seconds.
very specific with travel. Not everybody
oh, yeah.
is.
Maniacally so.
But it'll learn your preference. Like ideally, what you do is you learn your preferences. You only fly, I don't know. You only fly between 8 and 10 p.m.
Yeah.
and take an aisle seat and stuff like that. Like why,
I think
that's the benefit is the complexity.
I think the next thing is also like how many people want to give their credit card access to a bot and just have it start completing transactions for them. So probably there's going to be a step in between where like the agent comes back to you and says, okay, this is what it's going to cost. Yes or no. Like you'll be able to say yes or no, buy it.
Yeah, you certainly don't want to say buy me some Taylor Swift tickets, and it's like
Yeah.
$12,500.
Right. I think you're going to need like an interim step at least for a while when you're trusting one of these things with your purchases.
And so they built all this. It only cost $3 trillion. That's it. That's it. Now we could.
This is where the $500 billion of investment happening
So
in the next
what's
12 hours
crazy is that
going.
obviously this is where Apple has to get to, and they're playing
They're
from
not.
behind.
They're not getting there.
Of course they will. What are you, crazy?
I don't think so.
They have an unlimited amount of money.
Yeah.
And they're using ChatGPT. So of course they'll get there. They need Siri to be conversational. Right now, you have to say, hey Siri, and then Siri responds. And then the next query you ask is independent of the previous one. What they need Siri to be able to do is get us a reservation for 4 people at that Chinese place we went to in Rhode Island last year. And then Siri will say, you went to 2 Chinese places in Rhode Island last year. Did you want to go to this or
Siri
that?
will say, you want to see what movie? Siri has not improved at
But my
all.
point is they're rebuilding Apple Intelligence on the ChatGPT chassis, and they need Siri to become conversational and useful. Right now,
Yeah, I mean it sucks.
It's
Any person who's
literally
ever used
sucks.
it, like
but they're playing.
it's not even worth trying. That's the issue.
But you're not accustomed to seeing them play from behind to this degree. But they are.
The divergence in the stock price right now is pretty interesting. Like they're getting walloped relative to the other mags.
Even Buffett sold it. Buffett hates.
Well, Pelosi
Siri.
top ticked it.
She sold it, right?
Yeah, at least part of it. Hey, what's with the closed blinds today?
They're always closed.
Really?
Yeah.
I am
Oh my
so
God.
oblivious to my
Those books
surroundings.
are ordered
Yeah, where did
by
these books come
colors
from?
as well, in
Oh
case
my
you were
God.
wondering.
We all,
And can I just ask a simple question?
Yeah.
What the is this?
yeah, nobody knows.
It's decor.
Nobody knows, Bob.
It's decor.
Like
They're bocce balls.
I understand they're bocce balls or whatever.
Okay,
you
they're
know,
croquet balls. I'm gonna have a heart attack.
Oh, you did this
Wait,
for
is this a croquet ball versus this is a bocce ball? Or?
See, all right. If you've watched the show on YouTube, one of the things that you'll notice. So this is in the foreground
Right.
for the main shot.
No, I saw that last
This
week.
is in the backgrounds. This is an echo of that. It's what we call a motif. Okay. So the colors are literally identical to the way that we set up the colors on the bookshelf. So there's a visual. Duncan, am I explaining this right? Daniel, you look like you want to chime in.
Duncan takes no responsibility.
You have the microphone in front of
I asked this
you.
question when I walked in, and Duncan was like, "I absolve all myself of all responsibility,"
No, but
and threw you right under the bus about
It's
it.
from the curb thing, is what I was saying.
He
Yes.
said one time it was from a curb.
But what's the what am I trying? What's the scientific explanation for why you would want to repeat something in the foreground that's in the background? Get the out of here. All right.
I have to say, you
Really?
you seem
Did
a
you go
little
to fucking film school?
you seem a little sensitive about
I
this.
barely
Seriously,
graduated
right?
high school.
Yeah.
You can't help me?
Who knew this was a
Right?
trigger?
No, I didn't. I didn't realize that I'm never going to be invited back here. Just questioning his
Bob hit a
decor.
nerve with the motif.
I've painstakingly
The motif.
designed this set. If we let Michael design the set, it would
This
literally
wasn't here like 2 weeks
Yeah,
ago.
go on.
Right?
it would be like a half-ripped Pam Anderson poster from 2002 and maybe, I don't know, Kobe Bryant
Well, I mean,
jersey on the wall.
You guys looking for the next 100,000 subscribers? I think replicating
This guy breaking my balls. All right.
I don't want to go.
replicating his childhood bedroom is probably a good idea.
I'm an artist, Bob.
I was watching Meet Their Parents to go to sleep the other night, and there's Lil' Kim poster and
Yes.
the guys. What's this?
Still funny.
Dude, it's so funny.
Uh-huh. It held up.
It's so funny.
It held up.
There's a scene where Greg is just getting acclimated, Greg Fokker, to Bobby D, and his wife, Pam, or his fiance goes, "So, how was work, Greg?" And he goes, it's good, Pam. Thank you for asking."
Oh, you know who's funny? That Owen Wilson is great in that.
So I was thinking,
ex-boyfriend.
So Owen Wilson and Ben Stiller had an epic run.
Yeah.
Between that and Zoolander was huge at the time.
And what else?
Starsky and Hutch.
Oh, that was good too.
Love that movie.
I ju-
Manetti.
I just watched the opening scene of that because it was on,
It's so good.
and Snoop Dogg is Huggy Bear.
Yeah.
Oh, it's
And
great.
Vince Vaughn's in that movie.
Yeah,
Great
yeah.
movie. Let's go. Let's start the show.
All right,
right, we're doing the show.
claps coming in.
All right.
Episode 175.
Today's show is brought to you by Crane Shares. Ben and I just spoke to Greg Bond of the Man Group discussing bio on animal spirits. That's BUYO. We described it as Moneyball meets private equity. It's an index designed to replicate characteristics of PE buyout funds using publicly traded companies.
That's right, Michael. This fund targets small to mid-cap public companies included in the Russell 2500 index that exhibit the following characteristics. They belong to sectors favored by PE buyout funds. Think IT, consumer discretionary, industrials, and healthcare. They also match the profile of companies in which PE buyout funds tend to invest by screening for fundamental metrics. To learn more, go to
Craneshares with a K.com/BUYO.
do it today. 175, ladies and gentlemen, welcome back. Literally the greatest investing podcast that ever was or ever will be,
With the best motif.
with motifs out the ass. We have a very special guest today, returning champion, Mr. Bob Elliott in the house. Bob is the
Thank you for having me.
co-founder, CEO, and CIO of Unlimited Funds, an asset manager providing easier access to hedge fund strategies. Bob was previously the head of Ray Dalio's research team at Bridgewater. Bob Elliott, welcome back.
Thanks for having me.
We love that you're back. Not too much going on these days, though. It's hard to even guess at what we might talk about. Are these some of the more entertaining and exciting days of markets in the course of your career? Because I would say that for me, like every day is insane these days.
Yeah, it reminds me of about 4 to 8 years ago when
21?
I'm saying it reminds me of the 16, 17, 18 period.
Oh, okay.
Always something new policies, new incremental news. You got to deal with everything on Twitter. What's happening? Size it. Is it real? Is it not? How do you deal with all that? Finally things are getting a little exciting.
Today I was on TV and Trump made a remark at Davos looking at Brian Moynihan from Bank of America like, you better stop unbanking or debanking conservative people.
Oh.
He didn't even say crypto, but I think he meant that. But apparently there's controversy that like gun companies couldn't be banked. And then the banks came out and they were like, oh, no. We debanked these people, not because they're in the gun business, but because they were doing business with Cuba, which is illegal. Like the banks fought back a little bit, but I think Moynihan was a little bit deer in the headlights. I was on TV right after that happened. It derailed the entire show. We spent almost an hour talking about it. So to your point, every day you don't know who's going to hijack or what topic is going to hijack the commentary of the day.
Yeah, good for the financial media. You'll have plenty of content here.
Yes,
talk about every week. Main thing is how do you keep your head straight?
So
right?
How?
You just look right through it.
Well, you ask yourself, will this affect earnings?
Right. Will it affect earnings? Will it affect growth?
If the answer is maybe or no, look right through it.
And the key thing is, you could chase these things. Like look at tariffs, like incremental news, chase. That'll eat you alive versus you have to be disciplined to wait. Wait until you actually see what's going to be on the field, then have edge in figuring out how big a deal it is. Right.
Yeah.
Once policies actually come, look, he sits in the Oval Office first day. He's like 25% tariffs on Canada and Mexico. Like who knows? You can say anything in the Oval Office. Doesn't mean
you say 35. Could say 15.
Right. You could say 15 until we know what's actually going to happen.
Yeah.
You gotta be patient, and I think that's the thing that's hard because the media and Twitter, all this stuff. You're looking at all the wiggles, trying to catch the wiggles. You're not gonna win this game by trying to catch the wiggles ahead of the news. The news will always beat you.
Do you think the market will stop reacting, stop being so wiggly as he continues to just throw ideas out?
No, because there's everyone's trying to have a faster and faster response, right? And to be clear, like if you're on Twitter reading the headline and trying to respond, like you're later than every single AI bot that is trading, as the words are hitting the literal screen in terms of the incremental news. And so people are, there's just a race to try and be the most responsive, get ahead and, buy the.
Here's where I think is the puck is going next. If he's starting up with the banks about not making loans to Christian organizations, I don't know if any of this is true. I understand it's an issue and I'm not dismissing it. And the stuff Andreessen was saying about Operation Choke Point and how the crypto industry was literally debanked, I know that's true. I watched what they did with Signature Bank. They said, "Oh, you want to bank?"
Boom.
Yeah, you want what was it? So you want to bank Silvergate?
Yeah, you're out of business.
Yeah,
that was the thing.
Rockabye, baby. What did the girl say in New Jack City when she put a gun to the guy's head?
Oh God,
right?
That's
anyway. I watched them assassinate 3 banks that were crypto adjacent, so I know it's real. But where the puck is going next is ESG. They got rid of DEI in 24 hours. I don't think people understand how willing corporations were to be like, okay, no problem. Like they literally outlawed DEI in 24 hours. The next phase of this is to go to Vanguard and go to BlackRock and go to State Street, I'm guessing.
But ESG's over.
Yeah, I mean, ESG's been gone.
Doesn't matter.
Years.
There's still billions of dollars in these strategies. And I think they're going to try to outlaw it. They're going to say any decision that you are making that is antithetical to like profits, or not antithetical, but any priority that you're putting ahead of making investors money is anti-fiduciary and therefore illegal. They're going to do it. They're going to go after the colleges too. Like this is going to be every day. There's going to be a new story. I think we can look through it, but some of this stuff is going to leave a mark.
Like what? If you had to guess, like what do you mean?
Adina Friedman is the CEO of NASDAQ, and I actually have a lot of respect for her. She's at Davos, and she came out and said, no, actually, we don't regret the inclusion stuff that we've been doing. And NASDAQ, I think was just forced to repeal something where they wanted all public companies listed on the NASDAQ. Like the rule was going to be that you had to have at least one female board member and one LGBTQ board member, maybe. And
That's getting whacked.
well, it's gone.
Okay.
It's over. And I think they asked her, like, do you regret that you tried to do that? And she's like, no. Like, I think we've made a lot of progress for society with what we've been doing at NASDAQ. And she didn't back off it. I think she said, like, we're going to be a little bit quieter about it. And obviously the term DEI can no longer be used publicly. But I think, like, there's going to be, like, a real impact to this stuff. It's just hard to quantify. Does this mean I buy or sell, any given sector or stock?
No.
I'm not sure anybody can
No,
really do that.
No.
So
I'm not surprised, but it is amazing how quickly everybody bent the knee. Like all the executives, Bezos, Elon, and Zuckerberg and Sundar at the inauguration.
they have a fiduciary responsibility to bend the knee.
Yeah, I get it. So Sam Altman tweeted this morning or yesterday, watching POTUS more carefully recently has really changed my perspective on him. I wish I had done more of my own thinking and definitely fell in the NPC trap. What does NPC?
Non-playable character.
Okay.
It's a video
I
game
got it.
term for somebody that doesn't think for themselves in a video game.
I'm not going to agree with him on everything, but I think he will be incredible for the country in many ways, exclamation mark.
Okay. He had to do that because Elon surfaced something where he was congratulating Reid Hoffman at LinkedIn for all the money he raised to support Biden. So all of this is defense.
Yeah.
None of these guys are excited about Trump.
I don't know about that.
They might be excited about the policies. They're not thrilled that they have to kick in money for inaugural
I think these
balls.
large tech companies are very excited that he's there. They could buy anything they
I
want.
think Bezos is excited, or Bezos is forcing
Yeah,
himself to.
I don't know. I don't know about him specifically, but
you talk about what's the investment implication. The M&A stuff is a big deal, and particularly, being able, if you're a venture-backed company and you're trying to get an exit, like it has been a disaster.
how many deals are getting blocked next year? Zero.
Oh, I
Right?
think Zuckerberg is the most excited.
And so
for this.
if you're Meta,
Yeah.
right, you're out there, you're Alphabet, you're out there being able to acquire today anything you want, right?
I think
The world is your
Zuckerberg was
oyster.
the most under pressure from the left. I think he's thrilled to have that pressure completely washed away. And that interview he did with Rogan sounded like a gigantic exhale.
He was very happy.
I think he genuinely, first of all, he wants to get back to doing M&A because that's essentially the success of Meta is buying WhatsApp, buying Instagram. Like this is important to him. So I agree with you on that. I think some of them are more like, all right, we have to navigate this. I would throw Sundar Pichai into that boat, Alphabet. Not happy, not upset, just like, all right, this is what it is.
Yeah, and new leadership comes in. It feels like a big change because we're in like week one and everyone has to change their rhetoric, but everyone changed their rhetoric in 2020 and the years before that. And so it's not, this is just the normal path and rhetoric is also not what.
Rhetoric is not policy.
Rhetoric is not policy. Rhetoric doesn't influence what they literally do.
Yeah.
Meaningfully.
I think investors like the rhetoric though. Like I think I look at the Russell, I look at bank stocks, I look at industrial stocks. Like I think the investor class likes this rhetoric better than it liked Biden era rhetoric, especially Lena Khan type of rhetoric. Nobody liked that. Nobody wanted to hear from Elizabeth Warren. Nobody wants to hear from her ever again. Nobody wants to hear AOC or Bernie. Even Democrats, I think people want to get down to business in the investor class. And that's where we are. So are you as excited about the markets as everybody else seems to be?
Well, I think the expectations in the market right now are incredibly high, right?
Yeah.
Everyone thinks that this is going to be the most pro-business, pro-growth, somewhat disinflationary environment.
But can't that be self-fulfilling if everybody believes it, that they're more likely to invest?
Well, I think that's the question is, are the expectations so high that they're not going to be met, right? You talk about a $500 billion deal of, claims of $500 billion of AI investment. Like, is that going to happen? Like, probably not, right? At that scale, there's obviously more AI investment coming, but amongst those companies, like, that's just very high expectations that the question is, does the policy actually deliver, right? And there's certainly, and I think there's a lot of ambiguity out there on that, which is if you look at a certain subset of the policies, they're not particularly pro-business, right? If you look at the policies on immigration, that's not a particularly pro-business set of policies. If you look at the policies on tariffs, that's not a particularly pro-business set of policies. So the question is really where is it actually going to play out? So far, like we don't know. We don't know. I think that's an important thing to recognize. Hope is at max levels, and reality is still totally ambiguous.
So how much of this is going to be like macro, like employment, labor markets, interest rates, path of Fed funds futures versus, okay, what does NVIDIA actually earn next quarter?
Well, I think for NVIDIA itself, what they earn.
Well, not just NVIDIA, but the macro versus the bottom up.
Here's the thing. I'm a macro guy, so I'll tell you the answer, which is I think it's going to be macro driven, right? But the thing that are the macro drivers, like presidential policy and even congressional policy, isn't that influential on the macro drivers, right? In general, it's just not that influential. All the other things that drive the underlying,
but it could be inflationary or disinflationary for sure.
On the margin, it could be inflationary and disinflationary. So that's the question: are they actually going to deliver? Are tariffs going to 60% on China or not?
Yeah, right.
Or is it just rhetoric?
Well, if
those
you
are
knew
two totally different paths.
If you knew what he was actually going to do over the next 12 months, do you think you'd be able to like nail the trade?
Yeah.
Yeah.
You would know how to express it.
Yeah, if you have, let's say tariffs are at 60%, there are winners, there are losers. Right now, those two are priced basically to be the same, right? There's no differentiation in the market between tariff winners and losers in terms of earnings expectations and all that.
I guess tariffs, yeah, probably.
So that's a good example where, you could, if you knew that tariffs were going to be 60% and versus 0, those are two totally different outcomes.
I'm afraid to say this out loud, but it does feel like this is just a tough environment to fit. I understand everybody's bullish, which is never like a great thing. And analysts are now chasing. You don't want to see that.
Right.
But the economy is still growing. The Fed is easing. It does seem like a pretty, AI is gangbusters. It does seem like a pretty favorable time.
But that's totally consensus.
Yeah, I know.
And that's the issue.
But if you sell and this keeps going, the people that you sold for be like, what on earth made you sell? Because other people were bullish? That was why you sold? Like, it's a really hard thing, I feel like, to like give people a reason for why you would get off right now.
You're right. Consensus is what I just said.
Consensus,
100%.
Right. And it's across everything.
Yeah.
It's across earnings expectations. It's across bond market positioning. It's across, real yields, all of
credit spread.
So that's why I
spreads,
think
everything is bullish.
We've been talking a lot about this, where we are in the cycle, first year of a presidential term, third year in a bull market. It is setting us up, and obviously, who knows, for like a sideways choppy market. If we could just digest the last 2 years, I think that'd be great. Nobody's going to want that, but I think that would be a pretty healthy outcome.
Yeah, and just because if you pencil, everyone's penciling out, S&P at 7,000 and all that stuff.
Oh, that's going to happen. It's a lock.
Right?
And that's Michael's lock of the week.
Lock of the week.
This podcast brought to you by FanDuel.
7,000.
I mean, that's where the consensus is just they're galloping after the market. It's crazy, but they are.
They are. And so, you could easily get a sideways choppy market, some slightly less than desirable, fiscal policies that come in, tariffs, things like that. It doesn't take a lot. When expectations are that high, it doesn't take a lot to unwind them.
So a couple of things. My research associate, Sean, and I keep a list of the best stocks in the market, and it's fundamental and technical. Basically, what we're trying to figure out is like, where are people making money right now? Where are the highest quality names that are going up, that are not too overbought, but that are working? And of course, it changes. But like all those Mag 7 names just came back on the list this week. So every time people say it's like, oh, it's a rotation, it's like, not really. Like small caps are beating large caps this year, but Amazon just popped back on the list. It's going up. Alphabet.
This year, the last 3 weeks?
No, like this week.
Yeah.
This week. Alphabet came back on the list. That's with Russell starting to do as well or better than the S&P. And it's just so hard to not be in when that's happening. And it's We're going to talk about Netflix in a second. This is emblematic of this concept.
Well, I think one of the things that's interesting about that is if you look at the earnings expectations,
Yeah.
Mag 7 earnings expectations, the growth rates are still pretty high, but they're expected to slow.
Yeah.
The thing that is driving the overall market earnings expectations surging is expectations of the rest of the 493 surging from, low single digit type earnings growth to 15% by the end of the year.
Yeah.
That's where the gap doesn't make a lot of sense. Like, look, betting on how much disappointment would have to happen for NVIDIA not to, deliver earnings in the ballpark of what's expected, right?
Yeah.
The rest of the market delivering earnings that are going to accelerate from low single digits to mid double digits. That's a real question. Like, tell me the story about how that's going to happen with a stronger dollar.
AI.
But yeah, right, exactly. But where are those companies actually delivering increased earnings using AI?
Where does the source of that?
What's the source of it? I understand people are buying chips.
Falling dollar.
The dollar's up.
I know, but falling dollar could be the source of that if it actually falls.
But I mean, that's like,
no, I understand.
It's tech spending.
Right. So that's the question. But
no, the ROI from last year's tech spend.
The people who gain in the tech spending are the people delivering the tech infrastructure.
Mm-hmm.
No.
Right.
The ROI from the tech spend of last year. Like, hey, we bought all this shit from Oracle and Amazon, and look, earnings surprise, because it turns out we were able to not have to hire the next 2,000 people, and instead we're getting by with more tools and we're making more money.
Right, and that's the hope in the market.
That's the hope.
And there's one set of if you talk about the let's say the AI focused tech, whether they'll get the sales and the profits is pretty clear. Right, people are investing in AI.
Yeah, well, where are the customers' yachts is the question.
Right.
Yeah. Well,
right.
All right. So hypothetically, you got 10 gigantic drug makers all selling at 10 PE multiples right now, effectively getting no credit for anything they're doing. Sat out the bull market last year. Sat out most of the bull market 23 as well. Okay. What happens when one of them comes along and says our drug discovery costs are actually trending lower because we're replacing people in lab coats with AI?
But those they don't discover any drugs.
They make acquisitions of companies.
Venture-backed small businesses discover drugs. That AI benefit, I do
it's
some
an
work.
R&D. It's an R&D expense that's a benefit.
And the people who are benefiting from that are the small scale companies that are using AI to do drug discovery.
So that'll show up in the smaller ones before the larger ones.
Absolutely.
Okay.
Yeah, they're benefiting from it. There's been a stepwise change in that over the course of the last even couple of years. But the big companies, they're paying top dollar for those products, not the other way around. They're marketing companies.
I think people are bullish just on the idea that there will be continued margin expansion at the 493.
Well, there better be.
Right. And that's what it comes down to. Is there margin expansion of the 493 in an environment of relatively tight labor markets? Not super tight, but tight labor markets. And if there is margin expansion, who's paying for it? Right? Because the flip side of margin expansion is
less hiring,
less labor. And so this is the macro. The AI story cannot be divorced from the macroeconomic dynamics. And those are, if you have margin expansion, which is effectively priced into elevated expectations, then it has to be paid for by somebody else. So either the government has to expand its deficit or households have to massively save considerably.
What about the magic of productivity? Not enough?
But productivity, let's just talk about productivity. Let's say overall S&P 500 sales or whatever, corporate sales have to align with GDP, right? And so then you go to margins, which is just essentially labor's share of that GDP number.
Right.
Productivity supports the nominal GDP number and then gets distributed based upon labor share, right? And so if you increase productivity, let's say we increase productivity 2%, which would be a huge impact over the course of, say, a 5-year time frame. Computers increase productivity by 1 to 1.5 over 20 years. Right, so let's say we increase productivity growth by 2%. All you're doing is increasing nominal GDP growth by 2%, right? And amortized over a 10-year time frame. Let's say we have, the level GDP goes up instead of 80% over over a 20-year time frame, it goes up 110%. That's a big deal, but it's only 30% increase in nominal sales. That is not that big a deal.
Right.
Right. And so the only way to get the sort of earnings growth. So, if you go from nominal GDP growth of 5.5 to 7.5, which would be huge. I mean, that would be incredible nominal GDP growth. That's not even close to what you need to get the sort of mid-teens earnings growth that is being priced in by the AI boomers.
But these companies have grown way faster than GDP for the last forever.
Right. Percentage points, but it all has to reconcile back to GDP. Right. You have to. They can't grow outside of beyond GDP. Their sales growth can't be beyond GDP growth.
Global GDP
forever.
Though.
But global GDP growth is
who's saying?
weaker.
But I'm not saying forever, but it has been for the last decade.
Yeah, sure. But
They can grow their share within GDP, but it's got to come from somebody else.
It's got to come from somebody else, and it's got to come from somewhere. And productivity, all it does is it increases GDP growth by a few percentage points, and that is not close to what's necessary to get the type of earnings growth that the AI boomers are expecting. Mid-double-digit earnings growth requires that you have margin expansion of something like 1% a year over the next 10 years. Okay, where are you going to get that? 1% a year.
What about just efficiency? Somebody
has to save 1% a year, because if you fire people, right, if you don't hire people, all margin expansion is less money to labor relative to sales. Somebody has to fill that gap, because labor getting money, labor's income is spending.
All right, I'm lost. What are you trying to say?
Sell, head. This is not complicated. No, you're saying these earnings expectations cannot be met
without
economic growth alone,
without margin expansion.
Yeah,
and the only way that you get margin expansion like that is if some other sector of the economy just saves. So you either have to have the government budget deficit. Like, part of the reason why how have they continued to have margin expansion is because the government deficit is widened, right? Which is just a transfer payment.
You think Netflix could raise their prices because of the deficit?
Yeah.
Let's talk about Netflix
at an economy-wide level. That's exactly how it works.
John, put this chart up. So, Bob, when I was watching Netflix report earnings and the reaction to this, I was thinking about you were coming on the show later this week, just because I feel like this is so emblematic of why so many macro investors missed the boat on the upside in equities over the last 5 years. It's impossible to imagine a company like Netflix until it happens. So this is a company that actually benefits from increased competition. We don't have history books on companies like these, where the fact that the bear case on Netflix 10 years ago was that
Apple.
Everyone's going to do streaming, therefore it's a competitive threat to Netflix. It worked in the opposite way. The more companies did streaming, the more it validated Netflix's place in the budget of every consumer. And it kind of like enshrined them as, oh, this is how we consume content now. We just Netflix it. And it's really hard if you're looking at things like CAPE ratios and trying to figure out like what are stocks worth when a company this paradigm breaking comes along. So what I'm showing you here is the reactions to the last earnings report. And this only goes back to last January. They've had bad reports. The stock has, gotten killed when they've had a not so great quarter. But just generally speaking, how does anyone envision this? This is a company that actually continues to find growth in year 20 of what they're doing. Like
it's a consumer staple company. It really is. It's a consumer staple that trades with growth margins.
This is what they reported. Record subscriber growth. This quarter, record. Added 19 million paid subs in Q4. The new total is 302 million globally. Revenue increase 16% year over year to 10.25 billion for the quarter, beating analyst expectations. Earnings 427, beating expectations. 102% increase from the previous year. There's a lot of reasons for that. NFL games help. Mike Tyson back in the ring helps. WWE helps. Bringing back Squid Game, which is a global hit, helps, of course. But just the point, it would have been really hard for somebody 5 years ago looking at Netflix selling at 50 times earnings and saying, I actually think the stock is cheap.
All right, now kill him, Bob.
Turns out it was cheap.
It was
Turns
cheap.
out it was cheap. But who could have known? Like, you could have said to yourself 5 years ago, it's not cheap, I'm buying it anyway because I think it's going to grow. That would have been the right call. Nobody could have said 50 times earnings is too cheap given what Netflix is. But like, that's how it turned out. And this is just one example of, I could give you 50 off the top of my head. I can give you ServiceNow. I can give you all these cybersecurity plays. There are a lot of these stocks. And that's what I think has made it so hard for people, whether they're running long short equity or they're running like value-based strategies. So I just wanted to get your take on this phenomenon and whether or not it's gone too far at this point, or maybe not far enough.
Well, why did Netflix succeed is because they were an innovator in taking market share.
Yeah.
Right. And so there is a raft of companies that we don't want to talk about that are basically dead as a function of Netflix.
Yes.
Right. And so
or had to change their business
to
model.
radically change their business model, et cetera.
So throw Disney, Warner Brothers.
Yeah, exactly.
Put all those in that pile.
All of those in that pile, and not to mention all the cable companies, which aren't necessarily all public, but that's a wealth shift within the economy, away from laggards into innovators, right? The world,
but the net benefit to the S&P is undeniable.
For sure.
So you had 5 companies, 10 companies threatened with extinction by Netflix, and then some of them decided to join it because they couldn't beat it. But the net effect for the S&P 500, higher multiple, higher price. So it's a net, even though it's one company taking away from other companies, for the investor class, a net positive. I don't think those companies lost as much market cap as Netflix gained, is what I'm saying.
Yeah, that's true. And the question is, how long can that continue, and how much can essentially the S&P 500 gobble up, the world's market share? And of course, they're taking a market share on a global basis, et cetera. And so, I think there's circumstances like this that I agree with you that traditional like value metrics are not necessarily good indications of high market share grabbing companies.
Yeah.
In fact, they're quite bad indicators of high market share.
They're not designed to capture that,
because they're designed to they were designed like in the 50s.
Yeah.
When we had a static set of companies out there. And so they're not good indicators of what's going on. The question is, at the aggregate level, do you start to build up from the bottoms up to a set of aggregate assumptions that make sense or don't make sense? Right.
Okay.
That's why I think why I draw on in the Mag 7 or you could say the expectations of some of these high flying tech stocks actually seem pretty reasonable, plausible.
Yeah.
But the question is that going to extend to every company in the S&P 500? No. Right. But that's what's being priced in, is that it is going to extend to every company.
You think like the median valuation for S&P companies is pricing that sort of enthusiasm in?
That type of earnings growth expectation. Remember, what you see, well, first of all, the median, we don't have a chart here, but if you look at the median S&P 500 valuation, it's still pretty elevated, right? It's not as elevated as
it's what, like 17,
the market
18?
cap. Yeah.
It's not 22, but it's not 14.
But it's not 14. And that median valuation is typically lower than the market cap PE. And you look at that, and that's on earnings growth expectations for 12-month earnings growth expectations that are extremely elevated. And people look at 12-month forward PE charts and they take 12-month forward earnings as if it's true. And 12-month forward earnings is not true, right? Those are expected earnings. Expected earnings are not real earnings.
That always comes down over time.
They come lower.
Right. And so the reality is that's something like, a high level for the median company for a set of earnings growth that is already expected to be extremely elevated.
Okay, so is that the bear case that we're pricing in? That we're pricing in? There's too much enthusiasm for companies to be able to pull off Netflix-like feats on earnings, and they're just not going to materialize. And that disappointment will ultimately lead to lower prices.
Well, there's no value for safety. There's no
margin of safety.
Yeah, no margin of safety for the companies that are not high flyers.
Right.
Right. And that's not like a, we're having a financial crisis type story, but that's a stagnation, an asset price stagnation story.
Because the
Right.
starting values are just too high relative to what they'll be able to deliver.
Values and expectations. Yeah.
So credit markets are the same optimism as in credit spreads.
Sure, but that story in credit spreads, I think, is different in the sense of credit spreads ultimately arbitrage to whether people default,
And there's no defaults.
and there's no default.
Yeah.
And I think famous last words, but like there's nothing obvious in the next 12, 18, 24 months that's going to lead.
So why shouldn't
to a wave.
valuations be high? Like given the backdrop, it makes sense.
Well, no, why shouldn't that's an answer for why credit spreads should be low,
No, I'm
and
saying
why they
it
might
ma-
even be
it
good
makes
value at low
sense.
levels.
Given the motif that
What-
we're painting, we painting a motif here?
It's actually more of a tableau.
That's a
Would be the way
tableau.
I would phrase it.
Yeah.
It's more of a tableau. But I guess Michael's
But
at
the equity expectations are unbounded at the top side, right?
Right.
That's the issue. Is that there's no the expectations can be totally divorced. Are divorced from the reality of what you're actually seeing in terms of the bottom half earnings growth.
So Michael's asking slightly differently. If we're in an environment of very little, if not no default activity, why wouldn't the median multiple on earnings for public companies be higher? And it is higher, but why isn't that justified?
Because default and earnings growth are two totally different things.
Yes, but you would pay up for something that you deem to be. You would pay up for something that you deem to be less risky, wouldn't you?
Sure, but the credit spread defines what the risk of default is.
Yeah.
Which is so far out of the money
Yeah.
in this sort of environment that it's not particularly relevant to the equity price,
Okay.
right? Because the
They just happen to
the
mirror
option
each other.
value
though.
of the equity is zero at this point, right? Because the
Yeah.
odds that it goes to zero are the odds.
But I guess
who's defaulting?
don't
right?
you normally get high earnings multiples and low credit spreads concurrently? Don't those two things often go
Yeah,
hand
they're
in
usually
hand?
confirming each other. Yeah.
Because they're
Of
both
course.
expressions
Of
of
course.
like fearlessness.
Right. But you can have unrealistic upside expectations around earnings growth at a time when you have essentially no default risk or very low default
So that's right
risk.
now.
Or you can have reasonable expectations of
Okay.
earnings growth at a time when there's little
So you could have
default
low
risk.
credit spreads, but a 17 multiple on
Exactly.
earnings.
Exactly.
Okay.
What if we get low single digit earnings growth and even more margin expansion? That'd be fun.
Yeah, well then, a few more value investors are going to throw themselves out of the window.
I made an observation on the show that
They're just going to quit.
people didn't agree with, but I think I'm right about this. We were talking about JC was on the show. We were talking about credit spreads and junk bonds in general, and I made the point, and it was not my original thought. I think maybe Nick Colas told me this. The companies that are in these junk bond ETFs are the highest quality version of themselves that we've ever seen
Yeah.
because of this explosion of non-bank lending happening in the private markets. If you are a C-rated borrower, you have like 10 people dying to give you money.
Right.
That was not the case even 2 years ago, which I think should give us all pause. If we're trying to take our cues from the publicly traded debt markets, we're probably not seeing the real story.
Right. All of the bad.
You understand what I mean by that?
Yeah, I got it.
All the
Okay.
bad credits are pushed into the.
They're not in HYG.
They're not in HYG.
HYG is the blue chip of junk.
Right.
Okay.
Right.
That's a different situation than when most people started following junk bonds looking for blowouts or credit spread. My point is you just might not get the warning there.
But even lower quality bonds are trading at very tight spreads historically, even like outside of HYG.
Yeah, I mean
off market
off market. Yeah,
for now. They're performing.
for now.
So, but Bob,
Right.
just don't you think that something there has to be a trigger to like for people to change their minds, for like narratives to get reset?
Right. And so I think the question is, I mean, what's the story that is the trigger is disappointment, and that's how.
Oh, that's enough?
Other than
Earnings disappointment is enough?
credit shocks.
Yeah, I agree. Disappointment is
Right.
enough.
Disappointment is actually what turns market cycles through time, which is you get, let's say that, if you just go back to historical cycles, environments where there's minimal credit growth, right? Which is kind of what's going on right now. There's no credit problem in the economy. Credit growth is actually at recession-like levels right now. So what creates a turn in an economy where you don't have a lot of credit growth being responded, slowing down as a result of monetary tightening? It's that people build expectations to extremes, and then ultimately conditions come in worse than those expectations, and people start to reprice asset valuations as a function of that disappointment.
So that's in an 06 scenario where we started to hear about Bear Stearns has these two hedge funds that are loaded up with mortgages, and some of those mortgages are no longer paying, and they have to take a write down to the asset value of these funds, which means the investors in the funds have to take a hit.
Right.
Have to take a haircut. It's on paper, but they have to take it. And that is disappointment. And what that leads to is people asking questions that they weren't asking the day before of the other hedge funds that they're invested in, and the other asset managers, and the other holdings at banks. And that triggers some sort of a waterfall or a cascade effect of just people not being bullish anymore and being more suspicious. And so when people say, well, we need some sort of exogenous shock, I'm not sure. I think I agree with you. I think you just have people start asking questions that they weren't asking yesterday.
Right. And they're just a little more reserved, and
a little bit, but that feeds on itself.
Right. And households are like, well, instead of, using my OpenAI bot to do another dinner reservation and expensive tickets, they're like, we'll stay in and have some pizza.
That hedge fund story that I tell was the summer of 06.
Yep.
And by March of 08, it leads to the bankruptcy of Bear Stearns. It's less than 2 full years. It's 18 months of just slightly less bullish.
Exactly.
And it's not Bear Stearns in a vacuum, of course. This is taking place.
Yeah, I mean, lots of other things were going on in terms of the credit boom. But if you just look, I think people are coming into the year and they're thinking it's just like the beginning of 2023 and 24. Remember, beginning of 23, there was a 100% chance of recession.
It is not, right.
Beginning of 24, people thought that there was going to be 7 cuts, right? And that the economy was aggressively slowing. And in both those circumstances, kind of connecting to what's driving stocks here, from a macro perspective, what drove stocks up in both years, 23 and 24, was that growth ended up being a lot stronger than the terrible expectations.
Thanks to AI spending or whatever. But yes,
AI spending continued, the economy is more resilient to interest rate hikes than people expected, et cetera, because of income growth. Okay, well, you enter 25, totally different story. Growth expectations are at 2.5% to 3%. They're even stronger in what's priced into the equity market. And so we just have a totally different set of expectations in the market. And so it's just a lot harder to beat very elevated expectations, totally different than when we came into 23 and 24.
Yeah. You have this deregulation story. You have like the financials valuations have gone way up because now they're making a lot more money on a steepening curve and NIM. And there's just like a lot of drivers now that have already been in place that were not in place a year ago.
Right, that are priced in.
Yeah, fully priced
everyone's
in.
expecting things to be great.
Yeah.
And what that means is if things are great, we could have a fine year in asset prices. But if anything, if there's in the series, if anything disappoints, right? Labor markets are a little weaker than expected.
Well, let's go there. Here's another thing that could disappoint. You got another labor market report that I think it's not like emergency, but claims going up today. So that's like trending not in the best possible direction. It's not as stable as it was. Now it feels like it's a little unstable. It's not bad enough to make you feel like the Fed is coming in with the 7 cuts. So it's kind of like in a no man's land where the labor market is for sure slowing down and deteriorating a little bit. Some people would say that's healthy. It's normalizing. Some people would say that's a canary in the coal mine. What's this chart that we have? Labor concerns.
70% of GDP or of spending is consumer spending. And as long as we have jobs, as long as people are employed, they're going to continue to spend because that's just what we do.
That's right.
But our friend Warren Pies has a chart showing labor concerns, payroll breadth deteriorating to levels associated with recession. So what Warren and Fernando did was show the percentage of industries with job gains on a year-over-year basis. And it just went negative, which typically, at least historically, has preceded a recession. So maybe cause for concern here.
What do you think when you see this?
Yeah, the labor market's slowing down. It's gradually. This is totally normal in a kind. We're late cycle. There's been a tightening, and there's just these gradual cracks that slowly but surely emerge in the economy, and this is highlighting the fact that this isn't dropping off like a cliff, but it is slowly but surely weaken. The economy slowly but surely weakening.
This isn't layoffs as much as it is companies just not hiring as many people.
Just not hiring, right?
Yeah,
and that is part of that was essentially a payback, a bullwhip from the fact that they hired anyone they could find.
Yeah, this is hard to take at face value. Look how weird this chart is. Look how weird the pandemic was. There's still so many distortions that we have to work through.
See this moment in the mid '80s?
Tell us about that.
Well, you do dip into that kind of recessionary lack of job gains, but then you recover without an associated economic event. And I don't know that there's a specific reason why. That looks like it's 1986. I can't think of anything economic that would have mattered, but I just make the point. You did get a reversal without a recession being the reason for the reversal. And I wouldn't be shocked if we start to see more hiring now that the election is over and people have all this, irrational or not, confidence about Trump and his policies. If this line now reverses off of that level, I don't know that anybody would be totally surprised. What do you think?
Well, confidence is not confidence is partisan driven. Big
time, it's all political. We agree.
And what if you look at partisan driven rises in confidence relative to subsequent economic activity, they're totally unrelated.
Wow. Okay.
Totally unrelated.
So it's not going to bleed into any kind of real life activity.
You look at that down at the county by county level and things like that. It's unrelated. And it's why when you look at things like NFIB or ISM is influenced by this or confidence measures, those are simply measures of partisan views. They offer no macroeconomic.
They're not a predictor of what
value.
People are going to do.
They have lost all predictive abilities because they are entirely driven by partisan.
So what are some leading indicators that you still find value in?
Well, I think how traditional hard data indications
construction permits
of leading sectors of the economy. So look, if you look at what's going on with housing permits, housing units under construction, they're falling.
Not great.
Basically at the most rapid pace that we've seen, except for back of the GFC.
New home building
units under construction is plummeting.
Would mortgage rates with a 5 handle change that overnight, or not necessarily?
Probably not. There's a lot of. I mean, there's a lot of underbuilding and then a lot of overbuilding. I mean, you can't go anywhere without seeing another apartment building being, near completion and then being completed. Right, this huge supply coming into the market that's falling. So far, we haven't seen construction job losses, but at some point we will see construction job losses as those units plummet.
That's a meaningful leading economic indicator.
That's a meaningful leading economic indicator.
Yeah.
Or you look at something like, manufacturing investment, which surged as a function of the CHIPS Act and to some extent the IRA. Well, that peaked already. The peak is behind us, and that's starting to slow as well. Right. So the question is AI investment and stuff like that gonna pick up? But I think it's certainly slowing considerably. And if you get that investment, which had held up the economy it was a reason why in 23 and 24, the economy was stronger than people expected. That's now slowing rapidly. So you got the housing sector slowing rapidly. You have manufacturing weak, and you have business structure investment slowing rapidly. Those are all things that were kind of surprises to the upside of the economy in 23 and 24. They're all moving in the wrong direction.
The stock market is not pricing any of that in.
And the stock market,
it's ignoring it.
It's totally ignoring it.
Yeah. Right? So for how long could that happen? Can we do this trade policy uncertainty thing? How is this measured? This is a chart showing, John, chart 8. You got it. Trade policy uncertainty. You can see that the only other time it spiked to this degree was under Trump first term, and now we're right back here. I guess this is survey-ish, kind of soft data. I don't know. What does it say?
It measures media attention to news related to trade policy uncertainty.
So they're counting the articles?
So automated text search results.
Automated. So
Whatever. There's a series.
Yeah, whatever.
There's an index for anything.
All right.
Is trade policy?
Well, we're
uncertain?
ignoring
Yes.
this too.
Yes.
Would be my point.
Yeah,
big time.
And I think this is a good example. Where is the upside case on trade policy relative to what's priced in?
Where is the upside case?
What's the upside case on trade policy relative to what's priced in?
Well, what do you think is priced in?
That it's all bluster.
Oh,
and that's what
the market is saying. Ignore this because none of it's going to happen.
Can we go to the next chart? The earnings expectations. This is what you see: is tariff winners and losers. Earnings growth expectations are the same. Actually, tariff winners are a bit lower, but like expectations are the same. There's basically no expectation that tariffs are going to have a meaningful influence on economic conditions.
Yeah, we have not separated the tariff winners and losers in the stock market.
In the stock market. And so if these two things are the same, if people are saying, look, if you're a tariff winner or a loser, right, your life is the same.
Bob, what's in the winner bucket, just for argument's sake? Like what types of stocks?
Well, a lot of domestic oriented industries are big winners, right?
Where they don't have to worry about tariff stuff. So anything
versus,
any global
retail,
okay,
Walmart and stuff like that would be in losers, right?
Because they're going to pay up for merchandise.
They're going to pay up for merchandise and whether they can pass it through, et cetera.
Okay, chart 10, similar story. This is I guess Bloomberg chart: relief rally in tariff exposed stocks, equity baskets exposed to trade risks gain on Tuesday. Yeah,
this
so
would be so noisy.
Yeah, it's tough to say that the market is worried about tariffs.
But if you really thought that the market was meaningfully worried about tariffs, you'd see tariff winners have much better expectations than tariff losers. You'd see stock prices move strongly in the favor of tariff winners relative to tariff losers, and that chart doesn't show because it's just in the last 6 or 8 weeks. But if you just look at it beforehand, it's basically winners versus losers is flat.
So you're saying the market's current base case is the upside case right now, and we're not pricing in the potential downside of tariffs yet.
The market's expectation is that there will be no tariffs.
Yes. Okay.
Which is interesting because if you look at global assets, Mexican peso, Chinese yuan, their stock markets,
they believe it.
They believe it directly. So it's like all the EM investors are like, this is going to be tough.
Yeah.
Right. And all of the US company investors are like, it's all bluster. Nothing's going to happen.
I remember on election night sitting at the New York Stock Exchange and I remember Adam Parker sitting next to me watching the peso. And he's before they said it's Trump, the peso had already reacted, and it was crashing against the dollar. Let's do this rotation into European stocks.
This is from the Bank of America Fund Manager
This
Survey.
is super interesting to me.
This surprised me. It could just be noise, but it shows the monthly change in allocation to Eurozone equities. And everybody seems to be vocally very bearish, but yet this had a spike that you haven't seen in, I don't know.
Can I ask you a question? Do you think this is just portfolio rebalance in January? Because Europe underperformed, so people just like pressing the button. Nope, Europe's supposed to be 20%, not 18%. Add 2% Europe.
I'm shocked. I would just think that people are just running away.
But they're not. But I'm saying like nobody's bullish Europe, but they're just like pressing the rebalance button and buying it. You think that's possible?
I think that's probably what it is.
So do I.
I haven't talked to a single person who is bullish on Europe.
Right. I don't think there's like a story that people are passionate about. I think they're just getting back up to whatever their weight is supposed to be.
Let's skip the China stuff. Bob, I want to talk to you about bonds. So we talk about all the risks that is not being priced into the market. Bonds are offering safe haven, good alternative.
Yeah, I mean, look, when you got we had a couple years where the pricing, the expectations, the pricing favored stocks relative to bonds. Now, as we talked about, expectations have flipped. Pricing of bonds, tips are giving you 2.5%, right? On the long end, bonds are are starting to look like a good deal relative to stocks on a risk match basis.
What do you have any thoughts on the term premium? That's been a big topic of conversation the last couple of weeks.
Yeah, I mean, the term premium, part of what we're seeing in the bond market with the term premium steepening during a period where equity markets have held up is an indication that there is stronger growth expectations being priced in the market. Because part of what defines the term premium is essentially what's your choice to take cash today versus in the future, versus to lend it out and get a return in the future. And so if you saw the term premium rise sharply with the dollar falling and stocks selling off meaningfully, that would be indicative of people being worried about an inflation story and, the dollar and all that stuff. But that's not what you're seeing. What you're seeing is stock prices at all-time highs and term premium steepening. That combination of things is a pro-growth story.
Okay. That's the market saying.
The market is pro-growth.
Yeah.
That term premium expansion is pro-growth. And the thing that's interesting about it is term premium now is at, essentially the last time it was this level was pre-GFC. And so what that's implying, I mean, it's just one of many indicators that are in the rates market that look like we're basically pricing in a set of conditions over the next, 5 or 10 years that look as good as the pre-GFC boom.
PIMCO is saying bonds are better positioned to play a crucial role in portfolios in 2025. We believe bond yields are attractive at a time when equity valuations and credit spreads are not.
And the barber says Bob needs a haircut.
Giving high quality fixed income a favorable starting point. Unlike cash, bonds stand to benefit from capital appreciation as policy rates fall, enhancing their role as a diversifier and stabilizer for equity exposure in portfolios. Look, it's been very easy for a couple of years to just be long cash and not worry about bonds because who cares? So I guess they're arguing that time is now past. I think a lot of people are making that argument. Would you agree? Like, is lengthening duration the right move for most people at this stage in where we are?
Yeah, well, I mean, part of the question is bonds were challenging relative to cash in an environment of a lot of inflation volatility.
And high overnight rates.
Yeah. And so a lot of that, that's changed, right?
Yes, overnight rates are falling.
Have
already fallen a little and are
will likely
falling
fall more.
Yeah.
And inflation volatility has come down.
And intermediate term rates have gone up. They're more attractive.
And rates have gone up.
Yeah.
Or we were on the high side when we were moving, up in this most recent period. To me, it looked like a good buy because, the negative effects of bond yields rising had started to emerge in that sort of 4.75 to 5 range, 18 months ago or a year ago, right? When we saw it in the summer of 2023. And so we basically were bumping up to that same point again, except inflation wasn't at 6%. It was, it's at 3%.
A lot of the commentary this winter has been, maybe people are sick of lending to the Treasury because of, you name it, debt to GDP or deficits or both. Do you buy that, or do you think?
No, that's total garbage.
Okay, so
total garbage.
So I agree with that. Colas agrees with you.
Wait, Cook, why? Go on.
Rick Reeder agrees with you. Like the real people who seem to know what they're talking about scoff at that.
Well, I mean, first of all, you could see it. You could see the triangulation in the intermarket action, which is if people were really concerned about
lending to the U.S.
Treasury,
why would the dollar be so strong?
The dollar wouldn't be strong,
Correct.
And stocks would be crashing.
Correct.
Right.
We would be in a panic.
And you see that in traditional emerging market economies. Bond yields rise, the currency goes down.
Okay.
Right.
So it's politicians saying this, not
that's
intermarket analysts.
And then there's a fundamental story, which is all of this talk, like the U.S. is going to default on its debt. It can't pay back. The debt's too high. It's total garbage.
Debt spiral,
all that's total garbage. And the reason why that is if yields are too high given economic conditions, the Fed will just buy the bonds. Like how many of those people who are talking about the US debt spiral talk about what's going on in Japan? Is Japan having a debt spiral? Right? Japan's having, the currency's declining, but arguably that's actually beneficial. They actually need a currency decline, right? To stimulate a depressed economy. Right. But the bonds are paying exactly what the yield has always said. There's no default on the bonds, and their debt levels are a multiple of what
Okay.
the U.S. is.
So part of that narrative, so the Fed is cutting overnight rates, yet the 10-year yield is going in the opposite direction. It rises 100 basis points while the Fed funds rate is cut by 100 basis points. And the people who everything they look at, all they do is see politics. They come out on TV and they say, this is bond vigilantes, the first stage, and they are rejecting Trump plans for the economy. They're rejecting what Biden did and deficit spending in general. And we're seeing the opening stages of a serious financial problem.
But they're myopically looking at one market and not looking at cross market and seeing the holistic picture of what's going on. The reason why bond yields rose in response to the Fed coming in with a 50 basis point easing is because the Fed was too easy relative to conditions, which meant that stocks and gold rallied relative to bonds. Right? That's a positive return story.
Yeah.
Right? That's a growth positive set of pricing related to a bond yield cycle.
And not indicative of a debt spiral.
Okay.
Thank you for clearing that up for us.
You'll see a debt spiral when the dollar falls relative to other currencies and when stocks start to fall meaningfully in response to bond and bond yields continue to rise while stocks are falling.
Okay. We haven't had that yet.
We haven't had that.
We've had rising bond yields with rising stock prices.
We've had rising bond yields with rising stock prices. And what we've also seen is when bond yields get too high, stock prices start to fall, which sow the seeds of bonds rallying. That's literally what we saw in the last
people go to bonds for
6
safety.
weeks.
Yeah. It works like a charm every time.
It works like a charm, right at 5.
Yeah. If we were to burst through 5, would you say maybe something's changed or not necessarily?
No.
Can we talk about tips with you?
Yeah. Are we allowed to talk about tips here on?
Pro tips or anti-tips?
I love tips.
All right. Reflective of very elevated expectations to kick off the year, much higher than the last couple of years. This favors bonds versus stocks ahead. Outlook to kick off the year. So you wrote about this. Let's put this chart up of annual real GDP growth.
This is what I was talking about. This if you have one chart to characterize how to think about what's going on right now, it's this chart.
Okay.
Which is 2023, here's what the expectations were 0 growth, recession. 2024, the expectations were 1%, and actually in December, they were even lower than 1%. Today, they're actually a little bit higher as we've entered into January. They're like 2.5% growth. So why did stocks rally? Well, actual growth came in way above what the expectations were entering the year.
Look at the size of the surprise in stock price. The size of the surprise in stock prices makes sense in the context of how big the economic surprise was.
Exactly. That's not going to happen again.
You're not going to get that would be 6% GDP
exactly.
growth.
The only way you get a similar sized positive response is with 6% growth.
This is a great chart. So we don't know what the yellow line is going to be by the end of 25, but it's highly unlikely we surprised to the degree that we have in the last 2 years.
Right.
So we ran out of that rocket fuel of upside economic growth surprise.
Exactly. And that is when we talk about how you can have disappointment create a turn in asset prices. This is like classic. This is a classic setup.
Classic shit doesn't work anymore.
Classic macro setup.
Put up the tips chart, John. I think it's 16.
All you guys talk about these individual companies, and this is the only chart that.
Okay. What's going on here?
Tips.
Okay. Say more. Good.
Buy them.
Okay. Why are they a buy here?
2.5% real yields.
Okay.
You can lock in a 2.5% real yield, no risk for 20 or 30 years.
So why was it negative directly following the pandemic? It's just a function of the degree to which
people expected the
Fed funds rates to dropped.
Yeah.
Okay.
The economy needed massive stimulation, and what that meant was negative real yiels for an extended period of time.
So tips were a terrible buy.
They were a terrible buy.
And now they look so the higher so right now it's 2% plus
between 2
real
and 2.5%
yields.
real
this
yields.
is as attractive as tips have been in the last 20 years.
Since the global financial
25
crisis.
years.
Yeah.
Okay.
Yeah.
Right.
And
are the flows showing that people are taking advantage of this situation right now?
Oh man, nobody wants to talk about tips.
Okay. Well, because I guess 2.5. Why do you think that is? Like 2.5% is not that exciting.
2.5% real yield.
Dude,
Yeah, but
if you could
people
get 47,000% in Trump coin, why
Well,
would you
there
bother?
you go.
Yeah.
There you go. I know it's old school.
From an
but-
allocation perspective, though, tips versus what?
Well, certainly, why would you buy nominal bonds unless you think we're entering a deflationary spiral,
Okay.
right? When you could buy tips and just take the inflation risk off the table. Maybe there is
Yeah.
inflation that's too high,
Okay.
right? Right now, it's priced to be essentially 2 to 2.5% forever. You can buy these tips and not worry about it. That's number one.
I thought, so what's number two?
Well, number two is if you just look at what's the expected long-term return of bonds relative to stocks, right? Here, you're getting a guarantee. There's no risk, 2.5%, no risk. So the question is, how much return, real return, do you have to expect to get in stocks over the next 20 or 30 years in order to hold equity risk relative to bond risk? Because here you get 2.5 for free, guaranteed. You don't have to get out of bed. You don't have to do anything. You just buy these bonds, sit on them 30 years, and you will have compounded 2.5% real, right? So how much do you need in stocks? You need 6.5% real, right? For something like 4% above what this yield is. Okay, well, 6.5% real. I mean, you don't see a lot of 6.5% real growth over 30 years in equity markets.
Right.
Are you surprised? I thought like positive real rates were bad for gold.
Unless the Chinese are buying.
So what's the story? Why do you think gold is so strong?
Well, it is central banks buying.
Gold's a global asset. That's the most important thing to think about. When you're trading gold, the vast majority of gold demand happens outside the United States. And so most gold buyers are not looking at US yields. They don't care about US yields. If you're in China, gold is one of the few assets that you can basically hide capital in these days without, facing, government either surveillance or problems, because you can't move it offshore because there's intense capital controls. You can't really put it in Bitcoin and cryptocurrencies. Gold's like your only choice, right? And so you're seeing, particularly in China, you're seeing this, there's a deleveraging, somewhere between deleveraging and depression going on in China. Bond yields are falling rapidly. House prices are falling rapidly. The currency's falling.
So
what do you put your money
They're
in?
using gold.
You use gold,
Yeah.
right?
And then the central banks are too.
And then I say there's this underlying dynamic that has supported gold for an extended period of time, which is that central banks are buying gold and they're strategically underallocated to gold, and there's lots of reasons, geostrategic reasons, why you'd want to wean yourself off of dollars and hold other assets.
Well, they all watched
gold.
what we did to Russia
Exactly.
after the invasion, and they said, okay, what can we do that's not dollar denominated and sitting in banks that the United States
Right.
could effectively shut off?
Right.
And the answer is gold.
And the answer is gold. And so they're buying basically as much gold as they can.
Yeah.
And that's an underlying structural bid. And then on top of it, you've got a story where there's a global easing going on, which on a global basis, a global easing is generally beneficial to gold, particularly in those countries that, typically are big gold buyers.
And then there's Diwali season. Okay,
Yeah.
hold on. You have a comment. Another reminder: you probably don't have enough gold in your portfolio.
How much gold do you guys have in
Zero.
your strategic portfolio?
It's not
None.
part of ours.
Zero.
Zero.
Right? You and everybody else.
Don't need it.
What are you talking about?
I mean, it works with it. Works without
How
it.
many bonds you got?
Tons.
Tons. How's that done for you?
Well, it depends on the investor.
Sucked.
In some years, yeah.
Sucked.
In some years, gold sucks.
But that's the thing is, if gold, let's say if you're looking for a diversifier for stocks,
Yeah.
gold outperforms bonds in 50% of equity drawdowns.
Yeah.
Yet you hold
No
piles of bonds and
no
zero
current
gold.
income requires sale of principal for retired investors. Not quite the same risk profile either. Much more volatile.
A lot of investors don't think in Sharpe ratios. Like I know,
Yeah.
that's your world, but
Well, it's not. Forget about Sharpe ratios. Just think about drawdown terms, which is what lots of investors think about. You definitely want gold in your portfolio from a drawdown perspective.
I think gold-
because the time in which bonds are not helping you diversify your stocks is the time in which gold often is a beneficiary. I mean, just think about the last couple of years.
Yeah, it's definitely
Right.
worked the last couple of years. Let's put your table up. You're
But
showing
it's
us.
not just the last couple of years, it's the last 50 years.
Well, you're going to show us
75 years.
1973 to 2024.
This is from Eb Faber,
Okay.
basically shows, take two portfolios, stocks and gold, stocks and bonds. It's the same outcome. And
so the volatility in stocks bonds is nominally lower. Okay. I think most people know that offhand. Gold is, at the end of the day, a commodity. It's not the most volatile commodity, but it's not a bond either.
Right.
Okay. All right.
But you know what? Gold is a line item eyesore for investors. Like,
it hasn't been a line item eyesore for the last 25
but
years.
I'm just saying, but if you're in a stock bull market and bonds are lagging deeply behind, well, that's what bonds are. Nobody gives a shit. If you're in a stock bull market and gold has just gone sideways and not kept up for the previous decade.
So that's
really
2011 through 2021. That's a 10-year period where gold does nothing. Equities are doing roughly, I mean, this is crazy, but like 15% a year. Tech is maybe 25% a year in that period, give or take. Having an allocation to gold pisses off your end investor more in that environment than an allocation to bonds. Bonds didn't do great, but they weren't as volatile as the price of gold was, and they actually did make progress total return, especially if you're reinvesting. You could not say that about gold over that 10-year period. From 22, 23, 24, gold looks great, bonds look like shit. So it's flipped.
Right.
My point to you earlier, works with it, works without it. If you tell me you want to own gold because it's non-correlated and it's a diversifier, I agree. If you tell me you want to own gold because it hedges inflation, I think stocks are better at that. I mean, I know stocks are better at that. 200 years of history.
No.
I'm just saying.
But 200 years of history argument is
who cares about 200 years?
Is a bad argument.
Fine, 100 years,
150 years of that.
Yeah,
we were on a gold standard.
Okay.
So the price of gold was zero. The return of gold was zero. So that's not at all the monetary regime we're in right now. So the only monetary regime, the only reasonable corollary time is once the gold peg was broken and we floated on gold.
Okay.
Right.
The technicians are wildly bullish gold right now.
Yeah, gold looks great. But
and silver too. Are you bullish like specifically right now or?
Yeah. I mean, what I'd say is gold is a better asset to hold than to trade.
Yeah.
Because there's a lot of idiosyncrasies that happen in it. And so the point is buy it, 10% of your allocation.
Oh, don't trade it.
And don't trade it. Just hold it and just let it go.
I want to talk to.
Oh, wait, hold on. During the massive inflationary run up of the early 2020s, like 2020, 23, gold did shit.
Yeah, but this is the catch up now after the
give
fact.
me a fucking break.
I'm just telling you, that's the problem.
Now gold's hedging inflation now?
That's the problem with trading it. That's the problem with trading it.
That's why you don't trade it.
Because it could be a lag or a lead.
It's definitely a diversifier.
It's a diversifier.
For sure.
Yeah, we agree on that.
And that's where I would say, just think about it as a diversifier. Don't get too hung up on, is it precisely inflation hedge or not?
It's not.
It is, if you look back through time, it's very good at hedging extreme or even moderately high inflationary
but there's
environments.
One instance of that. It did in the 70s.
No, that's not. I mean, if you look back in developed economies over the last 100 years, right? You're focused on the U.S. and the U.S. experience.
I am a U.S. investor.
But if you broaden your horizon to think about all developed economies over the course of the last 100 years, like gold outperformed in depressionary environments, 2008, the Great Depression, et cetera, and in highly inflationary environments. And that represents like 20 or 30% of macroeconomic environments across developed economies over the last 100 years. So if you just look at the US and you look at this disinflationary period and that's what what you've grown up on, that is an unusual circumstance relative to the history.
But investors don't live in the last 200 years. They live in today.
Sure, fine. But okay, let's look at today.
Yeah.
Let's look at post 2020.
Does the popularity
bonds or gold?
Does the popularity of
then why don't you hold any gold?
Because it works without it.
You
also
hold plenty of bonds. You don't hold any gold
because it works. It works with it or without it. We know this empirically.
Listen, I think there are a lot of things that we would own if investors never got to look at them. But but that's not the real world. People line item their portfolio for better or worse. Like talk to Corey about this. Like for better or for worse, people line item their shit, and they just do.
It would be easier It would be easier if they didn't. You have a certain type of investor that you talk to, no matter how much money you just made them. The only thing they focus on is the one holding that's down.
Yeah. So Bob, if we could say,
but why do we own this?
If we could say, listen,
but why don't they do that with bonds? Why aren't they beaten?
We just told you why,
dude. People
they don't care about it.
People
one way or
don't
the
care
other.
about their bonds. They know what it is. You don't want to get like stock like volatility and no returns in gold sometimes. I'm not saying that's like the rational, but that's how people invest. We
Nope.
line item.
Nobody's mad when bonds lag a stock market. If you give people a 10% allocation to anything, I don't
What about
care.
in 2022?
Hold on.
They must have been pissed.
I don't care if it's
stocks-
gold. I don't care if it's whatever. If you give people a 10% allocation to something other than bonds and cash, and that thing significantly lags stocks or worse, goes down in a stock bull market, you have to answer for it like every day. So if you're trying to build portfolios for people that they can actually live with and stick to, that's a consideration.
So don't you think? I think managed futures are another great example of things that in a vacuum improve portfolio returns, volatility, drawdowns. People can't stick with them because they're
They
too
will
non-correlated.
sell them at the wrong time. They will absolutely parachute out right when they should be like getting more bullish.
Hey, let me ask you about this. Separate topic. So I feel like the Chinese stocks are the opposite of US stocks in terms of everything imaginable, right? Like as one-sided as optimism is for US stocks, China's the exact opposite. Would you be so bold in your personal account maybe to take a flyer or is this just dead money?
I don't trade markets that are not determined by macroeconomic fundamentals. And the Chinese stock market is a product of political decision-making by Chinese authorities. I mean, even one day they decide, that they should go down in order to hit all the wealthy people. The next day they decide the hedge fund should invest in them.
You think they're that powerful they can determine whether or not the market goes up or down?
Yes.
Then why are they allowing it to fall for 3 years?
Well, I think that's a good indication of the fact that maybe things that are not traditional macroeconomic drivers are driving the set of policy behaviors that we're seeing.
Okay.
Right. So that's the sort of circumstance, in the US case, you kind of know, like stocks fall, the economy weakens, central banks ease.
They fired a bazooka in September. They were able to pull off a pretty good 3-minute rally.
Right.
And then that was it.
Well, I think part of the reason,
I don't know how on command it is.
Part of the reason why it hasn't progressed is because they haven't delivered anything.
They just announced it.
I joked at the beginning of the year, they had their big fiscal stimulus, which is to give people money to buy toasters.
Yeah.
$10 billion. It's a almost $20 trillion economy. They're allocating $10 billion so that people can buy toasters.
That's a big stimulus for the toaster business.
It's almost, they're either totally incompetent or they know exactly what they're doing, which is that they don't care about stimulating the economy.
Right.
Right?
They care about toast.
They care.
I get it. We want to ask you some hedge fund stuff because you are one of the people that we know who are among the most knowledgeable. Given your experience as a GP, what are all the new LPs in wealth management missing as they allocate to alts and private equity and hedge fund-like strategies and things that they just haven't in the past? You've sat on the other side, famously at Bridgewater during a massive run-up for macro hedge fund investing. What do you think people are missing now who are coming from where Michael and I are in the wealth management space?
Yeah.
Because they seem to be voraciously allocating. So talk a little bit about what you're seeing and what you think might be being missed.
Yeah, well, I think one of the big things is everyone's into these illiquid products.
Yeah, they love it.
And not recognizing that you're not getting your money. So I don't know if you pull up chart 19, like one of the biggest things that you see is
what is this?
What this shows is the quarterly distribution rate of, private equity, venture capital, et cetera. And it is
yikes.
It is
you
terrible.
Can't distribute because there's no exits.
That's right.
Okay.
That's right. So when you talk to somebody about investing in venture capital, it used to be, you'd allocate, you get capital calls over the first 2.5 years,
5 years, 6 years, you get your money
and then
out.
5-6 years, you get your money back. The way it works now is all your capital gets called and you never see your money.
Yeah. Until companies can go public or get acquired.
Right. Which, and now we're seeing venture capital distribution rates at 5%. Essentially you're just never seeing the capital.
Yeah.
And that has all sorts of consequences around liquidity of portfolios because people aren't, particularly when we talk to like big institutional investors, they are stuck in a pickle, which is they expect the money to be coming in the door and the money's not coming.
They have nobody to sell assets to.
Right.
They can't sell out. They can't turn these companies fast enough to return capital.
And in particular, when you think about part of the whole story is very strong IRRs in these.
Yeah.
And when you had venture capital, you allocate in 2.5 years, 3 years, and then you get exit starting in year 5, et cetera. That's where you get very, very strong IRRs. Well, if it takes 10 years or 15 years to get your money, then it totally blows out the IRRs. Why would you ever invest in venture capital, pay all those fees, take that illiquidity when the cash flows are so extended?
I see.
So you
the
get crap
interval is
IRRs.
becoming so long that it's limiting how much you can make per year.
Exactly. And so basically in this sort of circumstance, it makes no sense to invest in these sorts of investments relative to investing in the public markets, right? You're having a negative penalty. Is
that one of the big drivers for why the private equity and alts people are coming so hard at wealth management?
Yes.
Yeah.
Because they need liquidity. They need another pool of capital to come in
Well, in particular,
while they're waiting for institutional capital to get
Right.
back out.
In particular, I mean, the way it used to work is you'd invest in a fund vintage, you'd get your money paid out,
And then you go back into the next
go back
one.
into the next vintage.
But you can't re-up if you don't get your money out.
Exactly. And so what do these companies have to grow their assets? So the only way to grow them is to go talk to people like yourselves to try and get, smaller scale investors to come back in.
I shudder to think who they go to after us. When they're done with wealth management, where do they go to FanDuel? What's the next?
Probably.
They go to Robinhood?
Bob, there was an article in the journal, hedge fund fees eat up half of clients' profits. Do you think this is a salacious headline? Do you think or because you were insider, do you think that it's, it's true, but, or it's total garbage?
Let's quote it. Just over half the industry's total gross performance was eaten away by fees over the past 2 decades, according to LCH Investments. That compares to about 30% between 1969
nice.
and early 2000s, said the company, which manages and advises on hedge funds on behalf of blah, blah, blah. This increases the proportion of gross gains being paid away in fees is clearly
You can
not
stop eating. Reading.
the advantage of investors. Okay.
Eating.
It's 50%.
Hedge funds have earned $3.72 trillion since the late 60s and kept $1.8 trillion of that in fees. Not bad. Not bad. What's the problem here?
Fees are too damn high.
Okay, but people are still paying them.
I mean, just think about this.
Happily.
The fees at this level,
Yeah.
it's not just that they're taking 50% of the returns. It means they're taking essentially 100% of the alpha. More than 100% of the alpha.
Yeah.
For themselves.
Because a lot of these are underperforming funds.
And
on top of it.
That's right. That's right.
Okay.
The fees happen whether you're outperforming or underperforming.
As long as you're net positive, the fees are happening.
Even if you're not net positive, right? You still take your management
fee. Okay.
Right?
Yeah. These numbers are eye-popping. Citadel is the most profitable money manager since inception. Earned clients $83 billion since 1990.
That is unbelievable. Wow.
And returned $9 billion in net gains to clients last year.
Hey, how do I get into this fund?
The problem is you don't know Citadel is going to be Citadel in 1990 because nobody knows that.
And by the time you know, you can't get in.
Right. Well, now they don't.
And that's the big issue is that
why won't Ken Griffin democratize his gains?
Because he doesn't want to deal with democracy.
One more for you on the same topic. This looks like a PR firm packaged this headline and sent it directly to the reporter at the Wall Street Journal, and then the reporter just published it. When I see stuff like this, John, put this image up. This hedge fund created an Excel on steroids. The need to analyze an overwhelming influx of stock data and do it fast pushed Man Group to become its own kind of tech company.
This feels like a headline from like 10 years ago.
Yeah, like everyone's a tech company now.
Yeah.
I don't know. You were at Bridgewater, so arguably you were at one of the most cutting edge data crunching hedge funds ever.
Excel on bath salts.
This seems like whatever they're doing is just like sort of par for the course. It's not that impressive. Oh, they have a souped up Excel. I don't know.
I think in the industry, the differentiator is not how good your tech is in general, right?
Even like for the D.E. Shaws and the Citadels.
I'd say the one area where that's not true is if you're in high frequency trading, it matters a lot.
Okay.
But I think about those
like Jane Street.
Yeah, those companies in many ways, those companies they're called hedge funds, but they're not really hedge funds.
Market makers.
They're not taking market directional positions on assets, right? They're market makers.
Yeah.
Right. And yes, if you're a market maker,
Sorry, liquidity provider.
They're taking a rake.
they're taking a rake, right?
Yeah,
It's
yeah.
just and look, if you can be in the business taking a vig, like it's a great business to be in.
Yeah.
But it's not a hedge fund. It's not directional positions. When you're talking about directional positions, like, yeah, you have to have a certain quality of tech in order to do that, but it's not the thing that's going to differentiate one firm from another. The thing that differentiates it is the quality of the investment strategy.
Should Seth Klarman have owned more gold?
So this
Everyone should have.
All right. Now this
owned more
one
gold.
sounds like a story that the PR firm begged the reporter not to publish, but they did anyway. Clients of Seth Klarman's Baupost Group pulled roughly $7 billion from the hedge fund in the past 3 years, losing patience with the famed value investor after a decade of lackluster returns. Baupost annualized at 4% a year since 2014. I just told you the S&P did like 15%. It's now $23 billion fund. Performance over the last decade is about a fifth of its historic returns, lagging virtually everyone. Lost money in 3 out of the last 10 years. Not easy to do, although not steep drops. I don't know. This guy wrote the book on value investing, probably the most respected value investing hedge fund manager. I want to say of all time. Would I be right?
Yeah.
Okay. Does anyone not worship Klarman in that corner of the world? I think this illustrates how long you could have a style that's out of favor for, and there's nothing you could do about it.
I mean, I think it's kind of incredible how long it survived.
It's still $23 billion, and they're underperforming for a decade. Massively.
Right. And
John, we have this chart, by the way. I know these aren't all great comps, but Vanguard 60-40, Pivotal Path Multi-Strategy, Third Point, Elliott, and black is Baupost. There's very little things that you could have allocated to 10 years ago that would have had a worse outcome. Not that they've lost people money, but like, wow, you pay a lot in fees for that.
I think the thing, going back to how can the funds take 50% of the returns and fees, is because allocators are so incentivized to invest in blue chip managers,
Brand names.
even if they suck.
Yeah.
And so
You don't get fired for that as
right,
fast.
there's some managers that are out there that have done poorly for a decade,
Yeah.
right? They've 15 years, and yet they are some of the biggest asset managers, some of the biggest hedge funds out there. And the reason why that is because if you talk to allocators, taking a risk on a new manager or a smaller manager, it just never makes sense from how they're incentivized.
If you're up in Boston and you work at one of those colleges in an endowment, and you're like, yeah, we're going to give 7% to Baupost, nobody's bothering you about that.
right?
Even if it doesn't work out, because it's just like, this is what you do. Okay, so there's a lot of inertia there then, and it survives.
And that's why, like, the problem of the hedge fund fees is not when the returns are good. Because when they're, a good manager, it's totally worth it, right? If you can get
Of course.
15%, pay your 2 and 20, totally fine.
Of course.
The problem is when you get 5% returns for forever, 15 years, and they're taking basically all of it for themselves.
Well, they don't give it back. Bob,
don't
did you have
give it
fun on the show this week?
Of course.
Dude, we love hanging with you. I want to tell people a little bit about Unlimited Funds, and then we'll wrap up the show. But give people kind of like the elevator pitch who haven't heard of your company.
Yeah, we I was a
You allocate to Baupost. What else?
I was a 2 and 20 manager for most of my career.
Yeah.
And starting a few years ago, decided to flip that and bring low cost indexing to 2 and 20, and make
You're
it
on
available.
like a little bit of it's not a crusade. You're not like you feel like it is. I know you're on a mission, but do you feel like you're like trying to overturn the industry or not really?
Well, I think it challenged the industry.
Challenge.
You
Okay,
know,
that's
I
a
think
good way to put it.
there's a lot of bad, like that headline said. There's a lot of bad stuff that exists in the industry,
Yeah.
and in the same way, in a lot of ways, Vanguard brought massive consumer surplus to millions of investors. That's what we're trying to do
Okay.
with the world of 2 and
So
20.
it's hedge fund like strategies in an ETF wrapper that's a little bit more customer friendly, but trying to do it intelligently. You're not doing alpha cloning.
No.
You're not trying to mimic people's portfolios exactly. You're trying to capture the various styles and strategies, popular strategies within the hedge fund world.
That's right. That's right. We built technology basically that allows us to look over the shoulder of the hedge fund managers, see how they're positioned in pretty close to real time, and then we put that we package that into an ETF wrapper. And the good thing about that is tax efficient, liquid, easy to invest in. You don't need to be accredited or anything like that. You can do it at $20 or $20 million. If you have 20 million, give me a call.
Are your old friends from like Bridgewater, et cetera, like, yo, dude, can you shut up? No, because I had stockbrokers be like, is there any way you could stop? Just because I was talking about commissions and conflicts and retail brokerage and telling all the stories. Like, you hear from people that are like, dude, we get it. Shut up already.
Oh, I mean, out on Twitter, you see it all the time where even the suggestion that you could build something that looks like how hedge funds are performing in an ETF wrapper. The venom it's quite remarkable, actually.
Yeah, I get it. Like
people are a little
wants,
sensitive,
right? Like nobody wants to
have their livelihood threatened.
Yeah, people are overpaid in every type of line of work under the sun. But I think in the hedge fund world, like most people in it would acknowledge, we are being paid a lot of money and we can't always deliver.
Right.
And that's really all you've been saying.
That's exactly
so,
right.
All right, dude, you crushed it on the show this week. I wanted just one item of housekeeping. Michael and I and many members of the Ritholtz Wealth gang are coming down to Naples, Florida, and we're doing client meetings and prospective client meetings. So if you are a fan of the show and you're interested to learn more about how we manage money, I would tell you to go to info@ritholtzwealth.com. Send an email, subject line Naples, and certified financial planners from the firm will be reaching out to see if a meeting makes sense and help you get on our calendar. And we'd love to say hello to you in person. Anything you want to say on that?
I am excited to speak with Brian Belsky. We sold out, no more tickets available, but we're going to be busy, so I'm excited.
Yeah, we have a lot to do while we're down there. Okay, wanted to ask you what you're most excited about for the future. What do you got?
In the short term?
I don't care.
The end of this cold.
What's that?
The end of this cold? I'm going to Florida next week, and man, I need it.
Let me tell you.
Our lives are not built for this cold.
Let me tell you a fun fact. The next time we'll have a sunset that happens before 5 p.m. is November of 2025. You with me on that? Feel good about that, Duncan? Yes?
Definitely.
John, you feel good about that?
It can't get any colder.
How about
and
that?
It can't get any darker.
All right. Bob, thank you so much. Guys, please follow our friend Bob Elliott everywhere. He is the man. Twitter, LinkedIn, all the places.
Even TikTok.
Go to unlimitedfunds.com, TikTok. And hey, everyone, thanks so much for listening. We'll see you soon.